Hello, and welcome to this training video. Today, you're going to be learning something very important. Financial statement fraud. In this segment, we'll be learning about the understatement of expenses. Oh, look! Our trainee is here. Welcome. Why don't you have some seat? So, you've recently become the CEO of a Fortune 500 company. You're earning $1 million a year. But don't you think you deserve a little more?
No, my compensation package is pretty good.
Oh, do they already, pay you a lot?
Yeah, they pay me a lot.
But, what if you earned more?
A little more. A lot more.
A lot more.
Is it possible to learn this power?
Not from an honest worker. Did I ever tell you the tragedy of Bernie Ebbers from WorldCom?
No.
Well, it all started back in 1983 in the state of Mississippi when WorldCom was founded. Now, WorldCom had a very successful start, and only 2 years after being founded, they had acquired over 60 telecommunication firms. And by 1989, WorldCom became a publicly traded company. Now, the 90s were great for WorldCom, and in 1992, WorldCom acquired Advanced Telecommunications Corporation for $720 million. But it didn't stop there. Just like a certain pink bunny, they just kept on going. 1993, WorldCom acquires Metromedia Corporation. 1994, IDB Communications Group. In 1996, they acquire MFS Communications for $12.5 billion in stock. And then, in 1997, WorldCom and MCI Communications announce a $37 billion merger, the largest corporate merger in US history. Now, despite just getting with MCI, WorldCom had already set their eyes on somebody else. And in 1999, WorldCom and Sprint announce an even bigger $115 billion merger. But at this point, the US government was done with the shenanigans. They were concerned that WorldCom was forming a monopoly, and so the feds came in and said,
"It's time to stop! It's time to stop, okay? No more!"
Now, despite the feds canceling the wedding plans, WorldCom did quite well for themselves, becoming the #2 communications provider in the United States. They would go on to report over $30 billion in revenue with 60,000 employees and 20 million customers. Life was good at WorldCom, and with Bernie Ebbers as the conductor, this corporate train was moving full steam ahead, and nothing would be able to derail them. March 11th, 2002. The SEC begins an investigation into WorldCom amid suspicions of corporate fraud. And only a month later, Bernie Ebbers resigns as the CEO of the company. And then, on June 25th of the year, WorldCom publicly admits to committing the fraud in order to meet Wall Street expectations. Their income and cash flows were well overstated. The result? Their credit is absolutely destroyed. and without any cash, they file for bankruptcy. Their stock price crashes, and the layoffs begin. So, how did we get here? Well, first, we need to understand expense understatement schemes. In this simple example, we have two identical companies. If we lower the expenses for one of them, we get a company with a higher net income. So now, where do you think our investor is going to want to put his money? That's right. He wants Company B, since it looks better on paper. Now you might be thinking, well, that's dumb. You can't just delete expenses. Well, it turns out you actually can. You could just omit the expenses by simply not recording them on your books. But that's not as much fun. So here are two examples of other expense schemes. I like to call the first one the investment. You hide your expenses by saying, "We didn't spend this money, we invested it. We clearly have an asset on our books, and not an expense." The next scheme is the procrastinator. When it comes to our expenses, we'll just record them tomorrow. Now that we are familiar with expense fraud, what kind of expenses was WorldCom trying to hide? Well, WorldCom's largest expense was their line costs, which consisted largely of the rental of telephone lines. This was a big expense that WorldCom felt they had to bring down. Now, how did WorldCom hide these expenses? The main way that they went about hiding these line costs was by capitalizing them. By characterizing their costs as assets rather than expenses, they moved their line costs off of their income statement and onto their balance sheet. As we know, the fraud was eventually revealed by internal auditors, dooming them to become nothing more than a subsidiary of Verizon. But how could auditors even detect this kind of fraud? Expense understatements are pretty hard to catch, especially if the fraud is perpetrated across multiple areas, like in the case of WorldCom. On top of this, auditors generally look for the obvious, like an overstatement of revenue. In fact, the first fraud risk mentioned in Audit Standard 2401 is on revenue recognition. However, do not despair. There are still some ways that this fraud can be detected. First, there are some red flags to look out for. One such red flag could be management's unusual concern over or participation in selecting accounting principles. WorldCom's management was very insistent on capitalizing line costs rather than expensing them. Another red flag could be unusual performance for the industry that they are in. If a firm has a significantly higher margin than their industry peers, this could be a sign of something going on. Not always, but it could definitely be worth looking into. A final red flag could be an inability to generate cash flows from operations while also reporting a growth in earnings. After encountering these red flags, there are some audit procedures that can be performed. We want to test the various audit assertions related to expenses, such as completeness, accuracy, occurrence, and so on. Some ways we can test these assertions are by obtaining documentation for expenses, such as invoices or voucher slips. We can also look at subsequent payments by reviewing the cash disbursement journal after the year end. And lastly, we can try and confirm accounts payable balances with the company's vendors and suppliers. And that is a brief introduction to financial statement fraud, the WorldCom Scandal, and expense understatement schemes.
So I think you get the gist of it all. You just need to understate your expenses and your income will be looking very nice.
Yeah, understate expenses, increase income.
Perfect. You're a quick learner. You'll make a great fraudster.
Professor, isn't this, like, morally wrong?
So that's a good question. So you just have to remember to rationalize. So just remember, we read it in the chapter, that crimes aren't morally wrong as long as you can justify them.
But how can I justify such a huge crime?
Another good question, Bill. This is why you're my best student. So, how can you justify such a huge crime? Well, with rationalization, there's a lot of justifications that you can come up with. Maybe you're underpaid and you feel that you deserve a little more money. Maybe the company had it coming and they really deserve to be a fraud victim. Maybe you were just gonna borrow the money and you planned on returning it at a later date. So now that you've learned about this kind of fraud, what do you say? Are you in on it? Do you want to do a little collusion, commit a little fraud together? Maybe.
I'm good. I'm good.
You're good?
Yeah, I'm good. I mean, it's my last name, so yeah, I'm good.
But it's a lot of money.
Yeah, I know.
But there's a lot to be gained.
Yeah, but there's also a lot of risk, you know. The SEC, you know, come in, drop some fines on me. I could go to jail, you know. I don't really want to do that. But thanks, though. Appreciate it.
Okay. I guess I'll see you around then.
Yeah. I might. Yeah.
Sure.
All right. See you around.
Catch you later.
Yeah. Bye.
Yeah.
Yeah.